A wealthy investor traded Qualcomm stock options today, March 4th, as the stock made a new high. And so in this video, we will analyze the unusual options activity to find out whether this wealthy investor is bullish on Qualcomm or bearish, so that we can set up trades in the same direction so that we can make money when the rich are also getting rich on Wall Street. So let's get to the data, as usual, of unusual option activity. As we can see here, today's biggest trade happening at 10:12 a.m. 8,000 contracts for the 230 strike price call options expiring October 18. They were paying $244 for each of these call options. So a quick calculation of the total trade cost is $1.9 million. Now, typically this type of trade we would only share with our membership, but this is a lower probability of profit trade in comparison to our membership trades, because you can see the delta is very low. And what we mean by that is, if you take a look at where $230 is, where the strike price is, okay, you can see that the stock would have to move from where it currently is to 230. That's about a 37% increase of the stock. So it is a lower probability that this is potentially could happen, and that is why the delta is very low at 13. By the way, if you are interested in the higher probability of profit trades, then make sure to go to our website where you can learn how you can gain access to the trades of wealthy investors that we share to our members. Okay, so this trade, because if we take a look at the chain to find out more about it, you can see here at the October 18th, this is 228 days away, 230 strike price calls. You can see that we are also in the same position, but because it is a low probability of profit trade, we don't put a lot of capital to work on this trade. We position size to manage our risk. Okay, so you can see the volume, 8,000, much greater than the open interest. So we know these are opening trades. Okay, and so as we saw, they were paying about $244 per trade on these call options. So this is what the trade looks like on the profit loss diagram. You can see that currently Qualcomm at 166. On the x-axis is the share price of Qualcomm. On the y-axis is the profit or loss. If it's below zero, this is a loss. If these lines, okay, and that's why you see that if the price goes down, this becomes a negative because this is a loss. Okay, if the price goes up, it becomes a gain. And so you can see that the trade here at expiration, it has to break even near that $230 strike price for this trade to be profitable. So what this means is that this wealthy investor expects the share price of Qualcomm to move up quickly, okay? Because if it can move up quickly, it could become profitable immediately, okay? It does not have to wait until expiration to actually hit 230, okay? If it takes time to get up to 230, it could actually be a complete loss. You could see that this is a complete loss. This blue line is still below zero at expiration because we have this theta decay of negative 2.21 per call option. So that's a very strong theta decay for this call option here. All right, and that is why there is a elevated level of risk involved in trading this, and that is why we don't position size very much in comparison to our membership trades, right? Which is a higher probability of profit trade. So if you're interested in those trades where we find what the wealthy investors are trading and they have a higher probability of profit, because sometimes they are wrong. And so you want to diversify your portfolio with the trades that are higher probability of profit in order to maximize profitability. Okay, and then we also reduce our risk with option strategy. So you can find out more on our website. As usual, please smash the like button, subscribe if you haven't, and have a great day.